Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. Proudly bringing you another one of my videos where I'm going to cover the 11 GIC sectors as reported by Standard & Poor's. Today's one that I've been asked for several times in comment sections on other videos. This will be on information technology. And I'm going to do a couple of things differently here. I'm going to go ahead and show the screens that I did to find what I called fairly valued companies in infotech. Now, a lot of questions I've gotten, a lot of comments I've gotten, people want to talk about the semiconductors specifically. So I also did a video on the most overvalued semiconductors, because although I'm always showing what I consider to be value stocks, I think it's important to recognize that all stocks are not fairly valued. That's why I have such small lists. So I've created a couple of different portfolios here, and I've also created a couple of screens. So what I want to do now is let's go ahead and turn to the FastGraphs Fundamentals Analyzer software tool, and let's start looking at what I came up with in the information technology sector. As usual, we're going to start with the dashboard here. And FastGraphs has developed this new dashboard. And you can see the recent searches or tickers that you've done. You also have some preset screens here you can view more. If you have a portfolio, it will give you a portfolio summary if you have it loaded. But it also shows you the stock market, the S&P 500, which is SPY ETF. And you can see that it is overvalued. Now, I've talked about this all the time. And for those of you who watch all the videos, I apologize for boring you, but a lot of new people don't get it. The blue line on this graph is a PE ratio of 18.92. And this clearly shows that the stock market, that's kind of an upper limit valuation going all the way back to 2004 here. The orange line is a 15 PE, which I consider a fair intrinsic value, which gives us an earnings yield of about 6.67%, or we'll call it 6.5% to 7%. And normally you'll see the market trades in relation to one of these two lines. It was coming out of the Great Recession, it was at 15 times earnings. There were other times where it touched 15. Those are ideal times, in my opinion. And people talk about beating the S&P 500. Well, I think beating the S&P 500 coming out of the Great Recession was very, very difficult because stocks were cheap and it went from being undervalued to overvalued. You could say the same thing about the Russell 3000. And once again, we got a 19.8. So 15 to 20 is the number I keep in my mind. If I change time frames, these numbers will change. Okay, here's a 21 multiple. The blue line is what we call the normal PE, or it's the actual market PE. But the point is, this is an analytical tool, and you can run those different time frames and see things. So suffice it to say, the stock market itself is overvalued based on measuring either the Russell or the S&P 500. But as I've often said, it's a market of stocks, not a stock market. And within the S&P 500 or the Russell, in either one, you're going to find fairly valued stocks, undervalued stocks, and overvalued stocks. And I feel the job of the value investor is to stick with fairly valued stocks. So what I did was I created a screen, okay, and I created a bunch of screens actually on the sectors. And on the information technology sector, I'm going to go to the total return because I did also screen for income, and the income stocks were included in this. Now, when you run the query up here, I end up getting 26 stocks that met the search criteria. Now, the search criteria was I looked for the GIC sector, which was obviously information technology. I also I wanted to mark the sub-industry sector so it would show up on a graph. Primary stocks. I looked for dividend yield. I looked for PE ratios, earnings yield of 6% minimum. This was where I really put in a value screen. And then I wanted a persistency score where the earnings growth was 60% of the time basically going up. Okay, now on the historic part, what I did was I wanted positive earnings growth over the last 5 years. Very simple screens here. On the estimate screen, I wanted a total rate of return greater than 5%, and I wanted earnings growth that was positive. Again, this is an initial screen. I will filter a screen out like this over time. And in the regions, I limited this to US and Canada. Okay, so then when I ran the query, these were the stocks that I ended up with. All right, now what I always do is I hit the Add to Portfolio button and I create a portfolio. and I've already done that. So I'm going to go into my portfolios. I'm going to look for when the portfolios were created, and I just created this portfolio. So I came up with Infotech screen, and I had 24 stocks in the portfolio that I created at the time. There's now 26, I might point out. All right, so I had these 24 stocks. From the original screen, I would update that if I was doing this currently today. But this was 24 stocks that came up. Now, I did take this screen, if you will, and I went ahead and created this portfolio. Okay, so I've got Infotech 2, and then I created Info Value as a view. Okay, and that allowed me to list a bunch of things here, like I've got dividend yield, PE ratio, earnings yield, and so on. So I've got all these factors that I'm looking for. And again, I'm looking primarily, earnings yield is my go-to. I'm looking for earnings yields above 6%. That's what I screen for. But I really want 6.5 to 7%. So the first value I would hit on this screen would be like Qualcomm, Sanmina with a 6.66. So my initial view of this, all these stocks are reasonably valued or close to it. For example, if I clicked on Semiconductor here, and just went and looked at it from what I created, you would see that this is, first of all, a non-dividend paying stock. There's no white line on this graph, number one, and there's no light green shaded area, meaning that the stock doesn't pay a dividend. As you can see up here, the dividend yield is 0. The earnings yield is 6.13%. The PE ratio, the blended PE, is 16.3. It's moving towards a 15 PE. As you can see, the stock has been dropping over the last year and a half or so, and it's moving into fair value territory. By my strictest definition, not quite there yet, but looking at earnings growth expecting to be very strong in 2026, and I'll go to the forecasting calculator, it's in my corridor of fair value. All right, now it's only a double B plus company. It's not an investment grade company, but it does only have 23% debt. All right, so this would be one I'd either wait a little bit to buy it, or if I bought it, I'd be looking at earning maybe a double-digit return at a 15 PE. Now let's go back to the historical chart. Notice that this orange line is a 15 PE. The blue line is a 15.28. On this max view that I've got here, the lines almost cover each other up, if you will. All right, and you can see that 15 PE has been a very realistic fair value for the stock, and it's moving into that now. But you can also see some cyclicality where you had different levels of growth, and you had this explosive growth over the last several years coming out of COVID. Part of that is making up for the trend line, but part of it is maybe what the company did. So your due diligence here would say, let's find out what ON Semiconductor really looks like. All right. So as I'm in this portfolio now, I'm going to go ahead and run through these very quickly. I'm not going to spend a lot of time. ACM Research, when I see a stock like this and I see a 70% growth rate, I also see that I've got 1,200% growth in 2018. So I'm going to cut some time off of this graph to try to get a realistic look. Now I'm seeing a 26% growth rate. I'm seeing a forecasting growth rate of only 2%. So this is all stuff that helps me make a decision. Do I really want to invest in this stock or not? Now, I'm not going to spend time on this one because it's not one that really excites me very much, because I find the growth rates here are not what I'm looking for. Now, the company has had a very good analyst scorecard. The analysts have been very accurate, which means we're looking at negative growth in 25 and going forward. I'm trying to figure out whether or not I want to look at these stocks closer or not. Next, I'm going to go into ADEIA Inc. here, which screened out. Don't like this company very much at all. It's very inconsistent, cutting the dividend. I would just pass on that or even delete it from the portfolio. Akamai is a very interesting company. It's a growth stock. And what you see here is a lot of price volatility. You can see a lot of price volatility in this stock over the years. But now the earnings growth has been about 17%. If I cut that first year out again, I still get double-digit 13% growth. The market has tended to price this at a higher level. All that is information. It doesn't mean that I believe it. It doesn't mean that I would bet my money on it. But having said that, it's currently well below its normal price-earnings ratio currently, which could indicate fair value, and it's pretty close to being at my strictest definition of fair value. So I would look at forecasting. Growth of 8.68% at a 15 PE would give me a 6.5 to 7% rate of return. Using the normal multiple over the last 5 years, I'm looking at an 18.8 PE, and that would give me a rate of return of about 19. So when I look at this, I go, remember, this has 2 years of forecast data, so I would go 7 years, and you see my PE, my normal PE has been about 19, and it's well below that now. If you're looking for capital appreciation, this might be interesting. It's a triple B plus company, only has 34% debt, which indicates it has a good balance sheet. Now, something else I've been asked about, so I'm just going to kind of go around when I feel like when a company intrigues me. I might want to go into my fiscal fitness part here, because people have asked me, do I ever look at things like return on invested capital? Well, I can look at the returns on invested capital, and recently the company has dropped, and I'm looking at quarterly here, so I want to go to yearly. I could do either one and look at the return on invested capital. Annually has averaged somewhere around 6 and 9%. All right, and again, I'm going to shorten some time frame here so this graph looks a little better, a little easier to read. There are times when the return on invested capital has been high. More recently, it's been about 6 or 7%, but this is reasonably consistent. Return on equity, I could also look at and see what returns on equity have been. I can also look at returns on assets and see what the returns on assets have been and just hover and point to these things. If I'm looking for share buybacks, this company has been pretty much consistently leveling the shares. They've only bought shares at a compounded annual growth rate of minus 1.2%. So in other words, they're buying back a few of their shares, but not a lot of their shares. But I can look at a lot of other things here. So I do want you to recognize, those of you who are not familiar with fast graphs, there's a lot of information. I've got full financial statements I can go into. I can go into the fund graphs. Fund graphs give me things like income statement, balance sheet data. I can look at the whole balance sheet at once by just clicking this and seeing what the numbers are. I can go into the ratios section. I can look at price to value ratios. For example, people always ask about enterprise value to EBITDA. I can look at their enterprise value to EBITDA. And of course, when I'm actually in the fast graph on the company itself, I can look at operating earnings. I can look at GAAP earnings. GAAP earnings are different because they include a lot of non-recurring charges, accounting convention, one-time write-offs, non-cash charges, and it's all based under GAAP. But you don't really see a strong relationship between diluted earnings on most companies as you do with operating earnings. So I tend to go with adjusted operating earnings. Next on the list is Arrow Electronics. Looks undervalued here. Again, it's a growth stock. It had a huge surge in earnings and a huge drop, but this is more or less coming back to normal. It is expected to have strong growth going forward. It's triple B minus with only 25% debt, has a very strong earnings yield. Again, if you want to call this a blue line company, the normal multiple has been about 8. It would be above that right now, but it would still, based on the growth, still give you a strong rate of return. But again, you might want to wait to buy this one at a little closer or a better area. So as I go through these, I'm going to just go through them quickly. Now, I think you get the picture. One thing so far I haven't been real impressed with is the cyclical nature of these companies. Okay, now, Avnet has increased their dividend very generously. They do pay a 2.5% dividend, but again, earnings are very inconsistent. And when I look at their analyst scorecard, half the time on a 2-year forward with a 20% margin of error, they miss it. And they've missed it a pretty strong third of the time on the 1-year forecast. So that, I think, is a testament to the cyclical nature of the stock's earnings. You can see earnings drop and rise and drop. They started paying a dividend. I can instantly see this on Fast Graph in 2014. By the way, if the company had any splits or spinoffs, I can click this button here, and we'll look for that coming up here. Like, for example, I go to Cisco here. There's been no splits or spinoffs in the recent time. Cisco has been growing about 7 or 8%. It's had a couple of down years in earnings expectations, and the stock got hurt, but now it's rallying a little bit. It has a 6.3% earnings yield. It's AA minus rated with only 26% debt. Average growth has been 7.68%. I'm kind of analyzing out loud here. It's only expected to grow at 4.6%, and that doesn't really give me a lot of potential rate of return on this stock going forward if the analysts are correct. And by the way, when I go there, I can just scroll down, and the analysts have been very accurate on this particular company. So this might be very believable, okay? But again, you want to do your own research and due diligence. So moving on, if I look at Crane, CXT is a symbol. Now this is an interesting stock because this is really the old Crane. Okay, now here's a classic spinoff. I can just click this button here and I can see, and by hovering, that they had the spinoff of the regular Crane, of CR. Okay, this is now Crane NXT. You can see the relation between earnings and market price, but this graph is a little bit misleading because it's not the same company anymore. I just want to point that out. Here's Dropbox. Dropbox has been trading at a low valuation. Part of it could be because their earnings growth is dropping. It was 27% on this max period, which only spans about 7 years or so. As I shorten it, it's still staying high at over 27%. Now, all of a sudden, I'm down to 19%, and I've got a 66% year added into that. So I drop it to 5 years, and all of a sudden, I'm now down to 12% growth. And now the stock is starting to make more sense. And my normal PE and over this time and the actual fair value PE of 15 becomes very relevant. And again, I can continue to shorten the time frames and get a good analytical view. Companies expected to grow at 7%. The 15 PE is an interesting number. It would give me a great rate of return because right now the PE is only 12. So I would get PE ratio expansion plus 7.7% growth, but no dividend. And that's how this calculation of just under 20% would come out investing in Dropbox today. Dropbox has a lot of debt, and that's something that you'd want to take into consideration if you were thinking about investing in it. This is one of the more interesting stocks that came up in the screen. Because let's look at Dell. After Dell went private and then came public again, all the years since it went public in 2018, the market has really valued this stock very inexpensively. The normal PE has been only 6.1, but you can see I've got low PEs here. The low is 3 and 4 times earnings. And then all of a sudden along came AI, and Dell's a big participant in AI, one of the big competitors to SMCI, which I talked about in a recent video. And now all of a sudden we've had it kind of revert back to a more normal PE equal to its growth rate, okay, which is 16.61. Again, when I change the time frame, I get these different numbers. These are guide. They're helping you analyze. So all of a sudden, for the last year or two, a 15-ish PE has become relevant. Now, the question for you is that real? Is that going to continue for Dell going forward now? So when I go into forecasting, growth is expected to be 17%. This is using Peter Lynch's P equals growth rate. This orange line now is a PE ratio of 17.19. You can see that by the orange box up here, the second line in the pop-up. Okay, if I went down to a 15-ish PE, this is 15.47 here, and clicked on that, that would give me a 19.89% annualized rate of return. If the PE was less than that, for example, if I'm looking at a PE ratio, which is 6.62, I can go down to 8.59. If I just got a little bit of expansion, I would lose money on the stock. So I can do these various what-if scenarios. Using the normal multiple here, it looks way overvalued. But again, that was a normal multiple all these years, and then all of a sudden along came AI, and all of a sudden the market reset this. So are you going to say the market's going to value this fairly now, or are we still going to be facing the low valuations? Again, those are questions you have to ask and do for yourself. Now, this is the kind of company I personally like. It has very low debt. It's investment grade, BBB rated. It has a strong earnings yield and a decent dividend yield, and a dividend that they started in 2012 that's grown every single year. I don't get too hung up on dividend and estimates, but what I want you to note how this stock has crawled the line, the 15 PE ratio, if you will. The forecasting graph says 7.5%. The historical graph shows 8.78%. Those are comparable growth rates, okay? So it's more of the same. So a 15 PE seems reasonable to me. 14.76%, we'll call it 15% annualized rate of return potential. So I like this stock very much. For disclosure, I am invested in my client portfolios in Amdocs. I do like it very much. It's an IT consulting and services company. And as far as the analyst scorecards, it has almost a perfect analyst scorecard. So that's one that I do like. The next would be Flex LD. You can see it's just slightly above the orange line. And all that doesn't mean you don't invest in it here, but it means that you've got information here. Like, for example, when I look at fast graphs, ever since the recession of 08 and 09, the stock has been trading at a discounted PE, somewhere around 10 to 12 times earnings. So again, as I change time frames, you're going to see that normal PE sits around that 11 mark. Now here we're down to almost a 10 mark. So when I'm doing forecasting, a 15 PE makes it look slightly overvalued. If I use a normal multiple for the last 5 years of 12.9, it does look overvalued. But that still would give us a positive rate of return. So the question is, when you're investing in a stock using fast graphs, you're investing with your eyes wide open. You can see that it's only been for the last year or so that the stock has traded significantly above the blue line. It did for a little bit back in 2018. It's all information that you don't get from other websites, in my opinion. Now, here's General Digital. This company has paid some special dividends, as you can see here. If that muddies up the graph, you can take the dividends off of the graph and look at the company just from a standpoint of earnings growth. Again, somewhat cyclical. It got really inexpensive. You can see how valuation works when you look at these stocks. Hewlett-Packard has been a blue line company since the recession. That's something you'd want to pay attention to. It would be a little overpriced on that basis right now. Jabil, as I call it, has had a real surge in growth and the stock price has reacted. Now we're starting to get some volatility here. We look at Magic Software Enterprises. I'm going to take this out because this was simply obviously an anomaly. And I still have an anomaly here, so I'm going to take another year out because I'm trying to get a picture of what this company looks like. And here's a classic case of how undervaluation is a great time to buy. Valuation matters, and it matters a lot. And high valuation is a poor time to buy, even moderately high valuation. This is during a time where the company's earnings actually grew, but the investors would have lost 5% of their money. And of course, from the peak, when the PE ratio got really high here, this has been a disaster for the last couple of years based on stock price movement, but it's not been that much of a disaster based on the operating results of the company. Again, no credit rating, but very low debt. On semiconductors, another interesting one, we can see how surges in earnings created a surge in price. And then as earnings weakened, when the stock got overpriced, we see it's moving back into fair value. I've already talked about it. OpenText is another one. I consider this stock very cheap right now. It looks very undervalued. Now, growth historically for the last 20 years has been about 14%, but as I shorten, the growth rate has slowed down. And from a forecasting point of view, it's expected to stay around 7 or 8%. So again, using the normal multiple, about 13.5, it looks very attractive. Using what I would call the fair value multiple, 15 times earnings, this would be an extremely attractive company. It does have a little more debt than I like, and it is only a BB plus rated company, so it's not investment grade. Progress Software is another one here. There's where I'm getting some issues with the dividends, so I'm going to add the dividends back on the graph so that you see them. They just started paying a dividend. There's no forecast for dividends, is all this graph means here. But the stock does look reasonably priced. It got very cheap last year, and it's moving back. It's got a little more debt than I like, however. Qualcomm is an interesting picture because you can see that coming out of COVID, we had this surge. Then we had a negative growth rate, and the stock price, of course, reacted. Then we had a very positive double-digit earnings growth rate, and the stock reacted. And now the earnings growth is expected to slow down a little bit, and the stock reacted. The company looks trading at fair value, but it's not necessarily potentially offering a great rate of return, but not a bad rate of return for an A-rated company with 33% debt to capital, which I think, again, is attractive. So Qualcomm might be one you might want to wait a little bit for. And then you've got Qorvo here. This is a non-dividend paying stock. You can see how earnings and price work. You can also see how the business is done over time. And you can see when we had a surge in earnings, you get a surge in price. When you have a drop in earnings, you get a drop in price. And now we've got a lot of volatility here, but now the stock has reacted. The real question is, what's forecasting look like? Is this strong growth going to be true? And the analysts have been reasonably accurate with the company. All right, here we've got Sanmina. Expected to have good 11% growth. That gives us a nice rate of return. It looks fairly valued here. Looking at the company historically, since coming out of COVID especially, it's been a very strong grower. Let's drop this to about 15 years, grown at double-digit rates. But again, as I look at this graph, I note that the market has liked to put a low value on this stock. So when I'm looking at forecasting, and this looks attractive, but when I go to the normal multiple of 9 times earnings, it doesn't look so attractive. You have to make those decisions yourself. This is a tool to think with, as I point out so many times in these videos. Here's TD Synnex. I like this stock. It's triple B rated, 30% debt, does pay a little dividend. Dividend has been pretty good, other than looks like they did cut it in COVID. The stock is trading at a very reasonable valuation. I'm expected to grow double-digit growth into the 14 or 15% rate. The analysts have been 100% spot on. This company's actually beat estimates most of the time. So this would be one that you might want to take a real close look at. And I've added it to my total return portfolios. Skyworks is one that's gone through a little bit of trouble recently. I am long this stock. It is expected to recover. It does have some cyclical nature. And then Verint Systems is one that's gotten real inexpensive here. And again, you can look at the longer term view and see how the price correlates to operating earnings. And that's it for the portfolio of Infotech that came up in the screen. But I did want to show you some other portfolios here. So I went and I created a portfolio that I called semi-overvalued, because I want to point out that I'm showing you stocks that are in fair value now. But if you look at, these are some of the more popular companies in the infotech and semiconductor space. Like if we look at Analog Devices here and look at its graph, you can see this trading at a very high valuation. And what I'm going to do, but it's got a great long-term dividend record. If you can buy this stock when it's reasonably valued, it would be one that I would really like. It's A- rated with only 16% debt. Okay, but let's go through some of these others. Advanced Micro Devices is trading at a very high valuation, but the growth rate has increased dramatically. You'd want to take that into consideration. But I do want you to note that some of these stocks are trading at very high multiples with very low earnings yields. That's really all I'm trying to point out here, and let you see that it is a market of stocks and not a stock market. ASE Technologies has gotten pretty highly priced now. Broadcom is very interesting because if you really look at Broadcom closely, it's had very strong growth, but the market has always valued it at around a 15 PE here. So as I'm going to forecasting on this stock and look at the earnings growth rate, P equals growth rate is a 19 PE, it looks overvalued. At a normal multiple, which has been closer to a 15 PE, it looks extremely overvalued. I own this stock. I sold half of it. I'm still keeping it. I bought it back in here somewhere. This is AI that's got the stock. It's such a high valuation historically. I wanted to show Cirrus Logic because here's one that just got overvalued. I think some of the AI hype. And then, of course, now we're seeing it kind of revert to the mean. So it's really about the individual company, not the market. Monolith Power Systems, another one that was trading at very high valuations. It really peaked out, and then now the markets, it seems to be correcting itself. So these are stocks that are overvalued. Marvell is absolutely insanely valued, in my opinion, today, although it's a good company that has good growth potential going forward, but the market is pricing it at a very high value. One of the jokes I like to tell people and clients is that I ask them a question, the definition of appreciation, what appreciation is. And a lot of them will say yes or no, depending. And my retort is, well, the definition of appreciation is when the other person appreciates what you own more than you do. And Marvell is a marvelous company, no pun intended, and it's got good growth potential. But I do think the market is appreciating this stock currently a lot more than I do. I would love to have been smart enough to have bought it back in here and patient enough to hold it as it hit these new heights, but I wouldn't want to be buying it today. NVIDIA is a real interesting stock because of, you can see how the market, the growth rate has been really exceptional, but if I use my scroll bar here and go back before the AI revolution, this company still had some decent growth, but it was spotty. If I take it back a few more years, we see that growth rates were, the market traded it within the growth rates. Now we've had this AI surge where the stock has really just exploded to the upside. The forecasting growth is very strong, 36% growth, and the stock's trading at a high value. But the point is, are you willing to pay this value? This is really indicative of risk. Theoretically, I wouldn't want to pay more than 36 times earnings to buy this stock. This is actually a 30 PE here, but 36 times earnings would be, this would be what my potential would be if I bought it at a 36 multiple. I would have a potential for this company to make me a decent rate of return going forward, over 17% a year. But the question is it going to trade at those multiples? The normal multiple for the stock for the last 5 years has been about 48 times earnings, and that would make it look cheap. But the point I want to get at is smart money or lucky money would have bought the stock back here when it was out of favor before the AI revolution hit. So these are just some stocks that are in tech. Here's Semtech. To me, now surging profits got people excited, and the stock looks very expensive now. So the point of all this is it's a market of stocks and not a stock market. But anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. I hope you enjoyed the video. If you did enjoy the video, give me a like, ring the bell so you get future notifications. Take a look at FastGraphs. There's so much depth to this tool. And when I'm doing videos like this where I'm covering a whole sector, I'm just skirting the surface of just how powerful this tool is. Like I say, it's the value investor's best friend, and I wouldn't invest in stocks without the perspective that FastGraphs provides. Thanks for watching, and we'll look forward to the next video that I have on covering the 11 sectors of the S&P 500. Thanks for watching.